treasury shares which get created and automatically get cancelled. Now that's some billions of dollars. The way it worked in ICICI Bank and Limited was that it got created and then ICICI used to keep selling those shares and book those gains in the P&L. Is that the kind of structure which will happen in this case, or how exactly the monetization will happen here?
Suresh, I agree. That was the case in that merger.
Yeah.
Now it's not permitted, so the treasury stock will be cancelled. The promoter holding will get cancelled against the equity shares of the bank.
Also, Suresh, I think important to understand that the entire 21% held by HDFC and HDFC Bank is construed as foreign shareholding. So when these shares get cancelled, automatically the foreign ownership limit in the bank has the potential to increase. And I think the increase can be about 7 to 8%.
So the outstanding number will be 65% foreign holding in the bank, in the combined entity?
Around 65 to 67%.
65 to post the merger, the combined entity will have a foreign holding of 65 to 67%.
That's right.
Yeah.
As we speak today. I mean, of course, we'll have to check out what happens after the regulatory approvals come through.
Yeah. And just final question is on the statutory appropriations, because see the problem and the relaxation that you have sought, because what's happened, Keki and Sashi here, is that clearly in one of the recent deals, without taking name, the regulator was not happy with the bank owning more than 10% stake in the insurance company. Now, how confident you are that the RBI will be happy with this kind of a structure? Because clearly they want to ring fence and go towards an holding company structure. That's point number one. And the second thing on statutory appropriations, as per my calculations, we'll have to raise 70,000 crores from the market to meet the CRR and SLR norms, just to meet the 22% requirement, 18% SLR and 4%, even after factoring in 12.5% on your deposits. So how do you plan to do all these things?
So a couple of things, Suresh. Number one is, if you look at both our balance sheets, we have been carrying a lot of liquidity, high quality liquid assets, which have been much in excess of our regulatory requirements. And we will continue to do so because that's a liquidity cushion that we have always patronized as a part of our asset liability management, number one. Number two is, as you know, we have been ramping up our distribution over the last couple of years, and more so even during the COVID year, we opened about over 750 odd branches or 730 odd branches. We still have a large appetite to grow our distribution over the next couple of years. It may be at a faster pace than what we have done this year. So a combination of the fact that both the entities have been building up or having high quality liquid assets much in excess of the regulatory requirements, the fact that we have a large number of distribution expansion plans over the next 3 years, the fact that a large portion of our existing branch distribution will migrate from a low vintage to a medium to a high vintage, which is when you will start to see the multiples of deposit mobilization going in a geometric progression. I think it's all about execution. I think the combined the entity will have the wherewithal to meet the demands of this enhanced regulatory requirements arising out of SLR or CRR, or for that matter, priority sector.
Okay. And final, go ahead.
Suresh, to answer your question on the bank, on the subsidiaries, my sense is there are already banks which own equity in insurance companies, and these are not capped, as you said, at 10%. So we will of course be having detailed discussions with RBI. At the moment, we have sought that the existing subsidiaries of HDFC and our associate companies will continue to be the subsidiaries and associate companies of the bank.
Okay.
And if you I believe I just realized that I think last evening. I think the team released the quarter results on the exchange. And if you really look at the momentum on the deposit mobilization, it's been an all-time high, wherein the absolute amount of deposit mobilization has been upwards of 1 lakh crores. So the organization has that capability. I think when the merger does happen, the fact that we will also get additional branches which will be converted, as Keki was mentioning, into full-fledged bank branches, the ability to mobilize more is something that is possible. So we believe that the regulatory costs arising out of this, especially on the reserve requirements, will be much lesser, or is much lesser than what it would have been in a previous state.
Sorry, I'll squeeze in one last final question before I sign off. What will be the role of Mr. Deepak Parekh in the combined entity?
Look, I think these are all issues which will get discussed over a period of time. And we are having a press conference at 11:30, so some of these issues will get addressed. Yeah.
Okay. Thanks so much, Keki and Sashi. All the best.
Thank you. The next question is from the line of Maruk Adajania from Edelweiss. Please go ahead.
Yeah, hi. Congratulations to HDFC and HDFC Bank. My question is similar to Suresh's. Are you very confident that RBI will not insist on the NOFSC structure for the subsidiaries?
Maruk, thank you for the question. I mean, as of now, we have kept the proposed amalgamation rather elegantly. But in the event that there is a need, we will be delighted to, we are happy to even go ahead with any structure or an alternate structure that the regulator may want us to do.
But Maruk, immediately the plan is to continue that HDFC Bank will be an operating bank as well as a holder in equity of other businesses like insurance, asset management, and so on and so forth. And there is existing precedence to that effect. If and when in future RBI requires these banks to move to a holding company model, then at that stage the bank will of course look at it and do it.
Makes sense. My other question was on the priority sector that you mentioned. You of course mentioned on PSLCs, etc. So the priority requirement of the merged entity or the merged bank, will that be lower than the current?
No, Maruk. The fact that the merged entity will assume the loans of HDFC Limited, which is at this juncture about 5,23,000 crores, and probably it will be higher at the time when the regulatory approvals come over. The impact on or what is required in terms of priority sector requirement will be much higher at that point in time. What Keki mentioned was that today we have an avenue or multiple avenues to meet that kind of a requirement. Yes, PSLC allows us the flexibility of meeting those requirements without the need for any incremental funding. So, of course, we cannot today, if you look at the market, there's almost about 550,000 crores of PSLCs being traded on an annual basis. And I'm sure, as the banks grow, this particular market will only increase. In the initial period, we will probably seek, higher proportion of our requirements through the PSLC route. But having said that, if you have seen our recent forays into the rural and semi-urban markets, we have been stepping up the MSME businesses over the last year or so. That has been growing pretty strongly. Even in this quarter, I believe we sort of grew at about 30% year on year, or a sequential growth of 8%. So we have a fair amount of strategies to execute in terms of meeting this enhanced requirement from priority sector. So a combination of what we can do organically, what we can do through the PSLCs is what our thought process is. Yes, it's not easy. It's going to be at a larger scale, but I guess the combined might of this institution once this happens, this transaction gets consummated. The fact that we are not today offering mortgages, especially in the semi-urban and rural branches of the country, we can start to do that. That will be an additional benefit arising on the PSL portfolio. So these are some of the thoughts, but it's a lot of hard work, but the entity is well geared to take on this challenge.
Sure, thanks. I just have two more questions. The first one is that you did mention about HDFC's DSA, so that will become the subsidiary of the bank now, right?
Correct. That is correct.
And will they be only doing home loans, or they can do other loans as well now?
That is something which will progress as we progress over the coming years. We will figure that out. But I guess they can also then start looking at distributing a much wider range of products for the bank.
Got it. And my last question is a clarification. You said what percentage of HDFC Bank customers don't own mortgages?
Bank customers in the bank. We have
Okay. We have 68 million customers today, and it's growing at a clip of about, on an annualized basis, about 10 million customers. Annualized, the run rate is about 10 million. The reality is that the penetration of mortgages in our book currently is very low. Once you open up, as Keki mentioned, once you open up the distribution, where we are able to offer mortgages across all our branches, across all our virtual channels, across our digital platforms, and it become, and the friction that is there today in the processes of lead origination and sanctions and disbursals will come down significantly. That will sort of help us to be very competitive in the markets for distributing the home loans product once this transaction comes through. We believe that the moment you start to penetrate more into your base, which is very similar to what we have done in any other retail asset product, if you look at it, we are reasonably a strong market player on retail assets ex-mortgages. So this is something that is lacking in us in this particular distribution of ours. I think once this product comes onto the board easily to all the branches and our other platforms, the penetration levels moving up itself will power the growth engine of the bank.
Thanks a lot. Thank you.
Thank you. The next question is from Adarsh Parasrampuria from CLSA. Please go ahead.
Hi, and big congrats to both the teams. I had one question. When would you call the merger a resounding success, right? What would be the metrics you would use to judge that? I just thought from there will be initial cost to the P&L for the transition, but there's still a big gap between cost of funds of Limited versus the bank. Would that be the direction over the course of next 2 years where you get a lot of benefits to say that would be a metric that would use to judge?
So what will happen, Adarsh, is that as HDFC branches start mobilizing other products and savings and current account deposits, the overall funding cost of the bank would come down. The present HDFC structure does not permit us, as you know, to accept current account and savings account money. And effectively what will happen is because of the merger, the overall cost of funds will come down. As the overall cost of funds will come down, to my mind, it will offset any additional cost that is entailed in terms of CRR, SLR, priority sector, or anything else.
And just to add to what Keki is saying, this is a very sticky product, okay? And the lifetime value of a customer's relationship with that bank just enhances when you start to put a mortgage into his product offering. One of the metrics that we would like to watch is what are the penetration levels of mortgage to our customer base. The moment that starts to move, that from a low percentage that is there currently to a even to higher levels, that itself will demonstrate the way our balance sheet will start to move. As I mentioned in the earlier conversation, this is going to be powering the moment we start to expand our penetration into our customer base.
Got it. And Shashi, just you did mention that the structure is being done elegantly, for the holding of subsidiaries. Anything that you could share? I understand that you seek regulatory permissions, but is it like just all the percentages stake will be held under the bank, right? That would be the current proposed structure, I believe, or is there something more than?
Yes, that will be the current. That is the envisaged structure.
Perfect. Thanks, and congrats again. Quite a big moment. Thank you.
Thank you, Adarsh.
The next question is from Anand Dama from Emkay Global. Please go ahead.
Yeah, sir. Thank you for the opportunity. Sir, how will the tech integration happen, and what will be the overall integration cost? Any thoughts over there?
See, fortunately, this is a product company which will be integrated into the technology architecture of the bank. It is not as complicated as a transaction system, where you have very high levels of velocity in that particular technology system. So this is like any other retail asset system that we would have. So all that needs to be done is to sort of integrate into our main core system or the GL system. That's the first. But once, since this is, not many people have been socialized on this particular aspect, during the course of now to the effective date, we will examine the scalability, the resiliency, and the robustness of the system of home loans and other surround systems as well. And we will sort of take adequate calls in terms of what is required, whether there's any change required, whether there's a change in the architecture, or whether if it is good enough for us to continue with the same. So these are decisions that we will probably look at it as we start to engage more and more from now to the effective date.
Integration cost. Hello?
Yeah. Sorry.
Can you put some figure to the integration cost that you will incur?
It's too early for us to even estimate that at this juncture. But considering the fact that we are already, expanding our investments, whether it's in distribution, whether it's in technology, whether it's in people, I don't see this to be a very significant proportion of our merger expenditure.
And you said the affordable housing bonds that you have is about 70,000 odd crores?
It's about 80,000 crores
80,000
of
odd crores.
housing bonds which have a maturity of more than 7 years. Original maturity.
Okay, so on that you don't have to maintain CRR SLR.
That is as per the guidelines of covering this particular regulation from RBI. But obviously, everything is ultimately subject to approval from RBI.
Okay. And so lastly, will you also have to merge the HDB Financial Services? Because I think one of the rationale that you gave for this merger was that you expect at some point of time the holding company structure norms would come and the lending business will have to sit into the bank. So does that mean that the HDB Financial Services also could be merged?
We will await some regulatory clarifications on the same, and we will abide by whatever is the regulatory directions on that particular aspect.
Sure, sir. Thanks a lot.
Thank you.
The next question is from the line of Shishadri Sen from Alchemy Capital. Please go ahead.
Thanks for the opportunity. Congrats, Keki and Shashi, on a game-changing deal. I have a couple of questions. One is a follow-up to Suresh's question on the CRR SLR. So is it now that the bank will start to build up on this excess liquidity leading up to the 1.5 to 2 years that we get on the merger, so that, at the time of the merger, you're ready to fulfill all the CRR SLR requirements? So this excess liquidity that is there on your balance sheet will go up from here?
I would say yes. We need to sort of have a very planned approach, a phased-in approach, so that we don't sort of really are not caught to sort of mobilize it in the shorter end. So I think we have enough. The transaction time for this particular regulatory approvals, I believe, will be anywhere between 15 and 18 months. So we have enough time for us to start mobilizing the reserves, the extra reserves, and also in terms of deposits. Yeah.
Also, I would add that the bank has sought time from RBI to meet these requirements of CRR, SLR, and priority sector. And let's wait for them to come back to us with their final decision.
Understood. Thank you. The second question is, how will the merged entity approach the developer business? It's something that HDFC Bank has traditionally stayed away. Now you're sort of inheriting a developer business. Will you continue to grow it as long as it stays within the RBI designated limits, or is it something that you will choose over a period of time to run off? And
One of the ways, Seshadri, to garner individual retail businesses to also give construction finance loans to property developers.
Yes.
So the bank would probably continue doing developer loans, but let Shashi answer that.
So, Sesh, the very fact that this is going to be a lift and shift in terms of dovetailing into the bank, obviously we will sort of. You're right. We don't have that expertise currently, but as Keki mentioned, we will be the entire on the human capital will all sort of seamlessly integrate with that of the bank. So will the expertise on the construction finance. Even that will also sort of get embedded in the bank as well. So we will ride on that expertise. And then later on, I'm sure that expertise will be socialized to a larger proportion of our credit verticals as well. So this is a thought process. And as Keki mentioned, since this is extremely important in terms of for the mortgage business, we will have to sort of do this. But having said that, we are very clear that once this becomes a bank, this will be in compliance with all the regulations that is expected out of a bank, even on the construction finance.
Understood. Thanks. And if I could slip in a third, jumping the gun here a little bit, but the bank is now open architecture, a little bit of open architecture on insurance distribution. Once the insurance company becomes your subsidiary, is that a situation that you can or thinking of revisiting?
Not really. The rationale for open architecture is to offer the choice and options to multiple to our customer base. That philosophy continues to be there and will be there. So we will continue to patronize open architecture even post the merger.
Thank you, and congrats again for a great shareholder-friendly decision.
Thank you. The next question is from Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi. I'm audible?
Yeah, you are.
Yeah. So, sir, congratulations on a merger. It's a really big historic moment. I want to understand on the OPEX part, like this quarter we have added as a bank over 560 branches. And now as we look to absorb all the employees of HDFC Limited and also gain from the branch network of HDFC Limited. So will that mean that we will like to go slow in terms of our own branch expansion? And how will that change our medium-term cost ratios outlook, which we have earlier indicated at times to reach 35% cost income?
Dear Nitin, we have a strong appetite to continue to invest in distribution, continue to invest in technology, continue to invest in human capital. With this product advantage that the bank will now get, we probably will be stepping up our distribution even more So our investments will be even more. We will be happy to make these investments. I'm happy even if the cost to income for a while even deteriorates. But definitely, we are very sure that once the investments have plateaued, the operating efficiencies will kick in, and the glide path that we had given, that from the time of the peak of the investments to and when you start to get the efficiencies on the operating leverage kick in, we will start to see the cost to earnings come down even further from that levels. So on a merged entity today, I think we are about 36 to 38% or 37%. As Keki mentioned, it's just about 8%. So on a merged basis, it could be somewhere around the 32 or 33% or in that range. Happy to even take it even further, just to ensure that we are not sort of cringing on investments, even if that were to go. But we are sure in the medium to long term, we will see a glide path of the operating cost to earnings coming down.
Sure, sir. Thanks so much.
Thank you. The next question is from Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir. Congratulations and thanks for the opportunity. I wanted to check if you have calculated and broadly by which year the merger could be EPS accretive, because clearly as per the pro forma number, as shown in the slide, there is a 3% accretion, but of course there would be some drag on CRR, SLR, PSL front. So just wanted to check your thoughts on by when the merger should be EPS accretive.
I think the merger will be EPS accretive from year one, from the first year itself, because 21% of the shares automatically get cancelled.
Sure. And any ballpark number on tier 1 impact, CET1 impact of the merged entity, apart from the investment which is there in the limited, which will be extinguished?
So it will be a positive impact because HDFC's tier 1 capital currently stands at over 22%, and this 22% is also calculated after reducing the investment made by HDFC in the bank. So when that gets cancelled, the capital will go up, and therefore overall from a capital adequacy perspective, it will be positive. It will be higher.
Sure. And the last thing, sir, you have mentioned that in the meanwhile, in the run-up to the transaction, there would be some adjustment to the banking model. So just wanted to check, what it could be. Would it be in terms of limited getting more, sourcing more PSL assets, or let us say moving to external benchmark sort of a regime, or what all could it entail?
No, nothing. Everything remains the same till the effective date, and upon the effective date, the branches of HDFC will then, over a period of time, start becoming full-fledged branches of the bank. Otherwise, nothing else changes. It's business as usual.
Right. It's just that it says that there would be some opportunity to normalize for adjustment to the banking model. So I was thinking if there is something that you are...
No, there is nothing significant different in terms of regulations between an NBFC and a bank. Whatever little differences might be there, we will of course do things going forward which will be compliant with the banking model. But that does not have any material impact on our balance sheet or our profit and loss account.
Sure. Thank you, sir.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Keki Mistry and Mr. Shashi Jagdishan for closing comments.
So I just wanted to say at the end that to our minds, this is very accretive from the perspective of shareholders of both HDFC and HDFC Bank. We will now be able to leverage the lower cost of funds of the bank together with its huge distribution platform and its huge distribution reach, with the efficiency in the mortgage product which HDFC has developed over the last 40 plus years, and also the fact that cost-income ratio currently stands at 8.1%. So I think in terms of combination, to my mind, this is probably one of the best combinations we could have had. Earlier, this did not make that as accretive a sense as it does today because of some of the reasons that I mentioned in the beginning, higher CRR, SLR requirement, priority sector, you actually had to go and borrow money and so on and so forth. But today it makes, as we believe, EPS accretive from year one.
Thank you.
Thank you all. Thank you very much.
Thank you all. Thank you, everyone. Thank you.
Thank you. Ladies and gentlemen, with that we conclude this conference call. We thank you all for joining us, and you may now disconnect your lines.